Hey everyone, welcome to TQQ Labs. Let me start with a quick quiz. A stock goes up 10% one day, then drops 10% the next. Did it return to its original price? Nope. You're actually down 1%. $1,000 becomes $1,100, then 10% off $1,100 leaves you with $990. Now what about a 3x leveraged ETF? Up 30% one day, down 30% the next. $1,000 becomes $1,300, then 30% off $1,300 leaves you with $910. 9% just evaporated. The index came back to where it started, but the 3x leverage product lost 9%. This is volatility decay. If you search TQQQ anywhere on the internet, 3 words follow it like a shadow: volatility decay. And after those words, you always get the same conclusion. If you hold TQQQ long term, it eventually goes to zero. Go to any investing forum and find a post asking, is going all in on TQQQ for the long term okay? The top comment is always the same. It'll decay to nothing because of volatility drag. On Reddit's Ars LEFs, it's no different. Leveraged ETFs are designed to go to zero. That single sentence has spread like it's a law of physics. In part 1, I dissected TQQQ's structure, daily rebalancing, swaps, its relationship with the NASDAQ 100, and at the end I introduced the term volatility decay. But I didn't give you a conclusion. Today I'm giving you the conclusion. Does volatility decay drive TQQQ to zero? Half true, half false. And once you understand exactly where that line is drawn, your entire perspective on TQQQ changes. This video dissects the monster known as volatility decay, piece by piece, the mathematical structure, the historical evidence, and the gap between what the internet believes and what actually happens. Stay to the end, and you'll be able to answer the question, can I hold TQQQ, for yourself? Alright, let's start by properly breaking down the math behind volatility decay. Here's the formula. A leveraged ETF's return roughly equals the leverage multiple times the index return, minus the leverage multiple times the leverage multiple, minus 1, divided by 2, times volatility squared. That's a mouthful, so let me pull out what matters. The first term is the return you expect. Index goes up 10%, TQQQ goes up 30%. That part. The second term is volatility decay. And the critical thing here is that the leverage multiple enters as a square. What does that mean? Double the leverage and your expected return doubles. But volatility decay quadruples. Triple the leverage, expected return triples, but decay goes up 9 times. Returns scale linearly. The cost scales exponentially. This is why volatility decay is dangerous. This asymmetry is the fundamental reason you can't just crank leverage to infinity. But here's what most people miss. The back half of that formula, the volatility decay portion, is proportional to volatility squared. When volatility is low, the square makes it even smaller. When volatility is high, the square makes it explode. Volatility decay doesn't operate at a constant rate. When markets are calm, you barely notice it. When markets are thrashing around, it hits you all at once. Let's put real numbers on this. When the NASDAQ 100's daily volatility is 1%, TQQQ's daily volatility decay is roughly 0.03% per day. Over a trading month, that's about 0.6%. Barely noticeable. But when the NASDAQ 100's daily volatility rises to 3%, TQQ's daily decay jumps to about 0.27% per day, about 5.4% over a month. Volatility tripled, but decay went up 9-fold. Here's the key insight. Volatility decay is not a function of time, it's a function of volatility. TQQQ doesn't automatically melt just because you've held it a long time. It melts when you hold it through violent market swings. That distinction is everything. There's a great analogy for this. Take an ice cube out of the freezer and it melts. But the speed of melting isn't just about time, it's about the temperature outside. Set it on your counter at 25 degrees Fahrenheit and it barely melts after an hour. Set it outside on a 95-degree summer day and it's a puddle in 10 minutes. Volatility decay works the same way. It's not about how long you hold TQQQ, it's about the market temperature, the volatility, during the time you hold it. So what about that internet claim? Hold TQQQ long term and it eventually goes to zero? Let me break down the logic behind it. The argument goes like this. The market goes sideways sometimes. During sideways markets, leveraged ETFs decay. The market will inevitably have sideways periods. Therefore, leveraged ETFs inevitably lose all their value. Sounds logically airtight, but there's a fatal flaw. First, leveraged ETFs decay in sideways markets. This is true. I'm not disputing it. When an index bounces up and down and ends up where it started, a leveraged ETF will absolutely lose money. The math I just showed you proves it. This is physics. But second, the market goes sideways long term. This is where it falls apart. Look at the history of the NASDAQ 100. Since its inception in 1985, has the NASDAQ 100 gone sideways over the long term? In shorter stretches, sure. After the dot-com bubble, it essentially flatlined from 2000 to 2015, 15 years. In 2022, it dropped and chopped sideways for nearly a year. But zoom out to 10 or 20-year windows. The NASDAQ 100 has gone up, overwhelmingly so. The NASDAQ 100's average annual return has been roughly 12 to 15%. That return more than compensates for volatility decay. Here's the point. Yes, volatility decay eats into leveraged returns. But if the underlying index's gains are larger than the decay, the leveraged ETF still makes money. Japan's Nikkei 225 illustrates the other side of this perfectly. The Nikkei hit 38,915 in December 1989, and it took 34 years to reclaim that high, finally breaking through in February 2024. 34 years of essentially going nowhere. If a 3x leveraged Nikkei ETF had existed in 1989, it would have been demolished. 34 years of sideways action and crashes, amplified threefold, with volatility decay grinding away relentlessly. This is the real-world basis for the fear that leveraged ETFs melt to zero over time. But the NASDAQ 100 is not the Nikkei. The NASDAQ 100 hasn't gone sideways, at least not in its history so far. Let me draw a clear line between when volatility decay is a problem and when it isn't. Scenario 1, a strong uptrend. The NASDAQ 100 is climbing steadily. What happens to volatility decay here? Surprisingly, you actually get a compounding bonus. When the index rises a little each day, TQQQ rises 3x, but the next day's starting point is yesterday's higher price. 3 times gains compounding on 3 times gains creates a positive compounding effect that can actually exceed 3x. This is sometimes called positive convexity or compounding bonus. Real data makes this concrete. Take 2017. The NASDAQ 100 rose about 32% that year. Volatility was low, the trend was consistent. How did TQQ do? Not a simple 3x of 96%, it returned about 132%. It beat 3x. In years with low volatility and a strong trend, the compounding bonus outweighs the decay. Leverage actually produced more than triple the return. Scenario 2, a sideways market. The index bounces up and down, going nowhere. This is volatility decay's playground. The index returns 0%, but TQQ goes negative. This is undeniable, and it's the scenario most often cited by people who say TQQ can't be held long-term. Scenario 3, a sharp drawdown. This is TQQQ's real enemy, separate from volatility decay. Honestly, crashes are far scarier than decay. The 2020 COVID crash, the NASDAQ 100 fell about 30% from its peak. TQQQ, down about 70%. The 2022 inflation bear market, the NASDAQ 100 dropped about 35%, while TQQ plunged roughly 81%. This is a different problem than volatility decay. Decay is a slow grind in sideways markets. A crash wipes out most of your capital in one blow. As one RLETF's user put it perfectly, people tend to focus on volatility decay and forget that major drawdowns are actually the bigger concern. Think about it. An asset that's fallen 81%. How much does it need to gain to get back to even? 426%. $1,000 becomes $190, and getting back to 1,000 requires a 426% gain. This is a far bigger problem than volatility decay. Decay might chip away a few percent per year in a choppy market. A crash destroys 80% of your capital in one shot. But here's where it gets interesting. Let's look at what actually happened with TQQQ since its launch. TQQQ launched in February 2010. Since then, it's been through every crisis you can name. The 2011 European debt crisis, the 2015 China shock, the 2018 US-China trade war, the 2020 COVID crash, the 2022 inflation bear market, the 2024 yen carry trade unwind, the 2025 tariff war. Each time, it crashed anywhere from 20% to 80%. Volatility decay was grinding away the entire time. And yet, roughly 16 years after launch, TQQQ's split-adjusted cumulative return is approximately 24,000%. The product that goes to zero if you hold it long-term turned into a 240-bagger. Over the same period, QQQ returned about 16x. TQQQ outperformed QQQ by a factor of 15. Of course, if 3x leverage worked perfectly, it should have done even better. QQQ's annualized return was about 19%. So a perfect 3x would mean TQQQ earning 57% annually. TQQQ's actual annualized return was about 41%. It fell short of the theoretical 57%. That gap is exactly what volatility decay and fund expenses consumed. But hold on. 41% annualized is still an extraordinary return, isn't it? When QQQ earned 19% a year, TQQQ earned 41%, not 3x but well over 2x. And that 22 percentage point gap compounds into an enormous difference over time. $10,000 in QQQ became roughly $160,000. $10,000 in TQQ became roughly $4 million. This is where volatility decay's true face is revealed. Volatility decay is not a monster that drives TQQQ to zero. It's more like a tax that shaves a 3x return down to roughly a 2x return. Imagine you're running 10 kilometers, but there's a headwind that means you only cover 7. The wind doesn't push you backward, you just don't get as far as you expected. Of course, if the wind reaches hurricane force, it can push you back. That's a sideways market. That's a crash. Now let me bust 3 common myths that have spread across the internet. Myth number 1. TQQQ decays every single day. No, it doesn't. TQQQ only decays meaningfully on high volatility days. When the NASDAQ 100 moves 0.5% up one day and 0.5% down the next, that gentle chop, the daily volatility decay is about 0.0075%. On a $10 share of TQQQ, that's less than a tenth of a penny. Can you really call that decaying every day? Annualized, that's under 2%. In an environment where the NASDAQ 100 earns 12% a year, 2% decay is noise. Volatility decay becomes lethal when the VIX pushes above 30, when the index is swinging 3% or more per day. Extreme turbulence. And those stretches make up only a handful of days each year. Volatility decay isn't a chronic illness that slowly drains you every day. It's closer to an acute episode that hits hard and fast, then subsides. Myth number 2. You should never hold a leveraged ETF for more than one day. Know where this comes from? ProShares' own prospectus. The company that created TQQQ writes, "For periods longer than one day, the fund's returns may differ from the target multiple." Financial bloggers translated this warning into, "You lose money if you hold for more than a day." A CFA Institute researcher commented on this exact phenomenon, and I'm quoting directly, "The financial blogosphere took the scary-sounding name of volatility decay and drew the incorrect conclusion that holding a leveraged ETF for more than one day is a cardinal sin." Myth number 3. TQQQ will eventually go to zero. This is the most extreme and most widespread misconception. Let's check the math first. For TQQQ to literally hit zero, the NASDAQ 100 would need to fall more than 33.4% in a single day. Is that physically possible? The U.S. stock market has circuit breakers. A 7% drop in the S&P 500 triggers a 15-minute halt. A 13% drop triggers another halt. A 20% drop shuts down trading for the entire day. The NASDAQ 100 falling 33.4% in one day is physically impossible. Circuit breakers stop the market before it gets there. But won't it converge to zero given enough time? The answer depends on the nature of the NASDAQ 100. If the NASDAQ 100 is a long-term appreciating asset, then TQQQ does not converge to zero. Volatility decay chips away at returns, but if the underlying gains exceed what gets chipped away, TQQQ keeps climbing. That said, nobody can guarantee the NASDAQ 100 will keep rising forever. That's the risk. But notice, that's a risk about the underlying asset, not about volatility decay itself. Okay, that's the theory. Now let's verify it with historical data. Not internet theories. What actually happened? Do you know which year had the most extreme volatility decay? 2022. The Fed hiked rates from 0 to 5%, the NASDAQ 100 dropped about 35%, and the VIX stayed above 25 for most of the year. High volatility plus a downtrend, the worst possible combination. QQQ returned about minus 33% that year. A simple 3x would put TQQ at minus 99%. The actual result about minus 80%. Less than 3x on the downside? Yes, exactly. This is also the math of volatility decay. In a falling market, daily rebalancing actually acts as a cushion. As the fund loses value, it reduces its exposure each day, so it falls less than a static 3x position would. Volatility decay doesn't always work against you. In a downturn, it paradoxically softens the blow. Of course, minus 80% is devastating. $10,000 becomes $2,000. But it's not mega to 99%. The difference between having $2,000 left and having $100 left is enormous. You can rebuild from 2,000. From 100, it's effectively game over. And look at what happened after 2022. In 2023, the AI rally began. Past backtest results don't guarantee future performance, but the data shows TQQQ's buy and hold return for that year was approximately 205%. Even after taking an 80% hit in 2022, a 205% gain in 2023 means $10,000 became $2,000, then recovered to about $6,100. Still short of the original investment, but miles away from zero. Let's walk through the year-by-year data. Past performance doesn't guarantee future results, but patterns emerge when you observe the data. 27Q up about 32%. TQQQ buy and hold up about 132%. It beat 3x. Low volatility, strong trend. The compounding bonus overwhelmed the decay. 2018, QQQ down about 18%, essentially flat. TQQQ buy and hold down about 24%. The index barely moved, but TQQQ lost nearly a quarter of its value. This is the textbook case of sideways volatility decay. The market rallied 10% early in the year, then crashed in Q4 back to where it started. That up and down whipsaw is exactly what eats TQQ alive. 2020, QQQ up about 48%, TQQQ up about 100%. Here it fell well short of 3x. Why? The COVID crash. From February to March, the NASDAQ plunged 30%, vaporizing 70% of TQQQ's value. The subsequent V-shaped recovery doubled TQQ by year-end, but the scar from the crash was too deep to reach 3x of QQQ. This wasn't volatility decay, this was drawdown damage. See the pattern? In years with a strong uptrend and low volatility, TQQQ exceeds 3x. In years with sideways chop or crashes, it falls well short of 3x. Volatility decay doesn't operate at a constant rate. It varies dramatically with market conditions. So the real question isn't, does volatility decay exist? Of course it does. It's mathematical fact. The real question is the NASDAQ 100's long-term return large enough to overcome volatility decay? Look at the data. Over the 16 years since TQQQ launched in 2010, QQQ's annualized return was about 19%. TQQ's annualized return was about 41%. Not a perfect 3x of 57%, but well over 2x of QQQ. That difference compounded over 16 years. 10,000 in QQQ became roughly $160,000. 10,000 in TQQQ became roughly $2, 4 million. Even after paying the tax of volatility decay, the gap is 15-fold. So how do people who understand volatility decay still justify holding TQQQ? One investor on an online community shared their experience after holding TQQ for 18 months. Their strategy was interesting. They split their capital 70-30, 70% in TQQQ, 30% in cash. Every time TQQQ dropped to a certain level, they'd buy more with the cash reserve. They rode out the 2022 bear market using this approach, buying the dips as TQQQ fell over 70%, steadily lowering their average cost basis. When the 2023 rally hit, they swung back into profit. See what this strategy does? It doesn't ignore volatility decay. It acknowledges that decay exists and exploits it. Volatility decay happens when prices swing up and down. If you buy after a big drop, you accumulate more shares at lower prices. When the rebound comes, 3x leverage applies to all those extra shares. It turns volatility, the enemy of decay, into an ally, a total reversal of the usual thinking. Now let me dig one layer deeper. There's a hidden cost that most people overlook when discussing volatility decay, the cost of borrowing to maintain leverage. To create 3x exposure, TQQQ needs to borrow the equivalent of 2x its assets. Borrowing costs money, interest, typically tied to short-term rates. When the Fed held rates near zero in 2020 and 2021, this cost was negligible. But in a 5% rate environment, the borrowing cost alone adds over 10 percentage points of annual drag. Borrowing 2x your assets at 5% means paying 10% in interest. This is separate from volatility decay, but on the internet, the two get lumped together under TQQQ melts. You need to distinguish them. Volatility decay is a mathematical cost from the market's ups and downs. Borrowing cost is a financial cost for maintaining leverage. When TQQQ underperforms in high-rate environments, it's not because volatility decay got worse, it's because borrowing got more expensive. If you don't understand this distinction, you'll blame decay for poor performance that's actually caused by interest rates. Let me bring all of this together. Here's what this video has shown you. First, volatility decay is real. It's mathematical fact, and it's undeniable. As long as leveraged ETFs rebalance daily, they will lose value in sideways markets. Second, volatility decay is a function of volatility, not time. Holding longer doesn't automatically drive you to zero. The decay concentrates during periods of high volatility. Third, volatility decay is not a monster that kills TQQQ. It's a cost that shaves a 3x return down to roughly a 2x return. As long as the underlying index is rising, a 2x return is still extremely attractive. Fourth, the real danger isn't volatility decay, it's drawdowns. Recovering from minus 81% requires plus 426%. Decay chipping away 5% a year is manageable. A single crash wiping out 80% of your capital is not. So let me answer the question one Reddit user posed. Can I hold TQQQ long-term or not? The answer comes with 3 conditions. Condition 1. Do you believe the NASDAQ 100 will rise over the next decade? This is a question about QQQ before it's a question about TQQQ. Without this conviction, there's no reason to hold either. Condition 2. Can you stomach losses of 70 to 80%? If you hold TQQQ long-term, you will experience at least one drawdown of this magnitude. History proves it. Down 70% during COVID, down 81% in 2022. You need the fortitude to not sell when that happens. Condition 3. Do you have a system for managing volatility, not just buy and forget, but a real framework? Cash reserves for buying dips, rules for adjusting exposure under certain conditions. The most effective way to reduce volatility decay is to reduce your exposure during high volatility periods. Without a system, you're trading on emotion, and that means selling at the bottom out of fear and buying at the top out of greed. That destroys far more wealth than volatility decay ever will. For someone who meets all 3 conditions, long-term TQQ ownership is viable. Past results don't guarantee future performance, of course. But historical data shows that during periods when the NASDAQ 100 was rising, TQQQ crushed QQQ even after accounting for volatility decay. For someone who doesn't meet these 3 conditions, long-term TQQQ is a disaster. You panic sell at minus 80%, miss the subsequent 300% rally, and walk away concluding, see, TQQQ decays to nothing if you hold it long-term. Volatility decay wasn't the culprit. Your own emotions were. One last thing. In all this discussion about volatility decay, there's something that almost never gets mentioned. The fact that methods exist to structurally reduce it. As I explained, volatility decay is proportional to market volatility. So what if you reduce your TQQQ exposure during periods of extreme volatility? You dramatically cut the decay. And when volatility settles down and a trend reestablishes itself, you increase exposure again to maximize the compounding bonus. This is the core principle behind algorithm-based strategies. It's exactly what TQQQ Labs has been researching. Detect when volatility is spiking, automatically shift to a defensive position. When volatility subsides, return to full leverage. Past backtest results don't guarantee future performance. But across a decade of data, we've observed this approach significantly reducing maximum drawdown while improving long-term returns compared to a simple buy and hold. Once you understand the math of volatility decay, you can see how to reduce it. Understanding the problem is the first step toward solving it. Volatility decay is TQQQ's enemy. That's true. But it's not an invincible enemy. It's a manageable one. You get wet in the rain, but an umbrella keeps you drier. In a hurricane, an umbrella isn't enough, but you can go inside. What's truly dangerous isn't volatility decay itself. It's not knowing about volatility decay. If you've watched this video, you now understand what volatility decay really is. You know when it's lethal, when it's irrelevant, and how it can be managed. You won't be shaken by TQQ goes to zero if you hold it long term. And you won't be fooled by TQQQ always goes up either. Both are wrong. The truth lies in between, and this video has shown you that truth. In the next episode, we go beyond volatility decay to explore the factors that truly determine your returns with TQQQ. This episode dissected the anatomy of decay. The next one covers the principles behind strategies that beat it. If you want analysis at this level, subscribe, like, and hit the bell. TQQQ Labs proves it with data. See you in the next one.